Great, it's already 7:33 and we'll go ahead and start tonight's webinar. Tonight, we're going to talk about year-end planning with attorney Michael Lee. And we're going to talk about estate planning, tax planning, and charitable planning. To start, I'd like to first introduce myself. My name is Xiaowei Li, and I'm one of the partners of RUI Attorneys, and I specialize in trust and estate planning. And tonight, our guest speaker, Michael Lee, I'll let Michael introduce himself.
Am I really a guest? I think I'm here kind of a lot. So it's great to see you all. Mike Lee for RUI Attorneys, and we're really talking about an exciting topic, maybe exciting, really where we are, and our objective of our webinar for tonight is we have 14 days left of 2025, and really just to be aware of what the law looks like for 2025, what it's going to look like for 2026, and is there anything in the last 14 days of the year that we feel that we want to do, or when we look at everything, we say, okay, we've basically got everything the way that we want, and we're in good shape. So that's really our objective, and my pleasure to be with you.
Yes, and tonight our roadmap is first we'll discuss a little bit about the new law. Now it's not so new anymore. It's the One Big Beautiful Bill Act. What's the new changes for the law, and Michael will do a detailed analysis, and then we'll talk about the charitable moves, QSBS, and also at the end we'll discuss a little bit about estate planning documents updates in general. Okay, and before we start the webinar, as usual, we'd like to just let everyone know if you have a private, if you have any questions, feel free to send us a private message. This webinar is for educational purpose only, and this is not a webinar we try to provide legal advice. Okay, with that.
This is for academic and perhaps entertainment purposes only.
Yes. Okay. Without further ado, maybe Michael, you can start tonight's presentation.
Well, great. Let's get started and see where we are. So really what we're looking at is that most of us are calendar year taxpayers. And as calendar year taxpayers, our tax year ends on December 31st. So transactions, things that we do that are on this side of the line, on the December 31st side of the line, and before that's in the 2025 year. And then everything else is going to be in the 2026 year. So there's a little bit of a thought of which side should some transactions on. So it's a natural point to take a look at some timing and some planning. So really what we're going to be taking a look at is just a couple of things, and things that none of it is terribly new. Luckily, not much has really happened in the last couple of months. But with the last 14 days, looking at things like how did the One Beautiful Big Bill Act change a few things, some thoughts for charitable moves. The OBBB did do a number of good things for estate taxes, but it caused a little bit of a negative implication for some charitable planning that we'll see in a moment. It did some good things for QSBS. It did some good things for gifting, but we'll take a look item by item to see where we are. So let's take a look at our first item here. So what has changed? This is, of course, the law as it is now. One of the good things that the OBBBA did is it made permanent and extended for or increased for inflation the 2020 the prior estate gift tax exemptions. So in the coming year, 2026, the exemption will actually increase to $15 million per person. So that is good. So we now have this $15 million amount, and we don't have to worry about the sunset anymore. There's no more sunset. This $15 million, this exemption per person for U.S. citizens and domiciliaries, that's the key asterisk to remember, for citizens and domiciliaries, this is permanent, as permanent as laws of Congress are. So this is, of course, the foreseeable future. We don't see anything coming that's going to change this, but 2026 is also going to have a midterm election, and the results of that we will see if the OBBBA bill lasts. 2026, everything's going to be the same, but when they seat the new Congress in 2027, we shall see. That's to be determined. So that was a good part of the OBBB. Another good part was the SALT cap was increased. So the SALT cap is now higher. It was capping at $10,000. It's now going to be 30,000. So for all of us Californians here, it's going to give us a little bit more of a tax deduction if we are an itemized tax deductor. We will get some relief. If you're some of our for your friends and colleagues from Washington State and clients from Washington State, this won't matter to you because you don't have a state income tax. But for us in California, it's quite high. We will get some relief there. One thing that I'll just mention quickly and kind of allude to on this is this did do something negative for creating a floor for charitable contributions. And what does this mean is there's a 0.5% floor for charitable contributions starting 2026. So what does this mean is that basically for 2026, it'll take my income, all of my income, hit it with 0.5%, so a half percent, take that half percent, and I have to donate over that half percent. So I have to donate over that half percent. Um, for the parts that are below the half percent, I don't get a deduction on that. So what is the thing to think about is if one was considering a large deduction or a large donation, one wants to get the most bang for their buck out of their charitable donation. There is some minor sense that you would want to do that in the 2025 year instead of 2026 because there will be a floor there. And then in some situations, you also have to take a look at that there will be a cap on it. So that's really more for very, very high income earners. So let's move on a little bit to the next one. Those are just a prelude to some of the other things that we're talking about. One of the other things that the new act did, and this works together. This is two items that are related to each other, is QSBS and the high estate tax exemptions. So QSBS, what is this? We have a webinar on it. Feel free to take a look on our YouTube channel. You can find it where we really dig into the details of QSBS. But QSBS is fantastic. It's a wonderful thing. It's also actually one of those few times that is relatively good tax policy and is also good for taxpayers. And basically, it is if you create a startup company that is a C Corp and it is the proper business activity and was really truly a startup that started off the ground, you will get when you do your exit, you leave, you're bought out of the company or you're acquired and you receive cash, you get a certain amount of that buyout tax free. Well, it has usually been after 5 years of owning the stock and your stock got purchased for $10 million, you got $10 million tax free. $10 million tax free. It's great. Why did you get that? Well, they said, well, you took a lot of risk and you struggled through doing the startup. And we want people to do startups. If the choice was do the startup and take a lot of risk or just work at, a high paying job, well, we kind of want people to take a little bit of risk. But if we say, well, actually that hurts me and I basically pay taxes the same either way, I should go with the sure thing. Well, this maybe incentivizes you to be entrepreneurial. Well, this got better. This got better with the OBBBA, that act. Couple things. One is we now have a higher number that can be tax free, tax exempted. It can now be up to $15 million. So that's a large amount there. So that has gone up. Also, they now have adjusted the holding requirements. So you used to have to hold 5 years. Now you can hold 3 years. If you get bought out in 3 years, well, you get half. You get 50% is the tax free. 4 years, 75%, 5 years, 100% if you meet the requirements. So this is good. It's more flexible. These uh, changes also expanded some of the eligibility thresholds by the holding, and more companies and more shareholders may qualify for QSBS. So if you are in the startup space, this is something that you'd want to be taking a look at, as closing out 2025 is thinking about some planning moves. If you are part of the company, is, oh, we are S Corp, are we in the right business activity? Have we set everything up in the right way? Is there anything, that we should do? QSBS stands for Qualified Small Business Stock, or sometimes Qualified Small Business Shares. So that's what qualified means. It's qualified as the particular type under the tax code that if it's sold, it is tax free. So it's generally for me working in a startup business and having that kind of stock. The traps, and why this is usually something that's good to take a look at the end of the year. It's good to take a look at it all the time, but at the end of the year is thinking about like late documentation. As the tax year closes, depending on the particular business entity, whether it's calendar year or fiscal year, you're going to be, you know, uh, filing your tax returns. Well, if there's a high likelihood that one may qualify for QSBS and you're taxed as an S corp, well, maybe you need to consider C corp. Well, that's a big discussion because that's going to completely change how income tax is done for the corporation. But starting early, you may want to take a look at it. So this is something that there are a lot of new opportunities for QSBS coming, but one needs to explore early. The other thing that's important for QSBS is QSBS has traditionally been linked to what's called QSBS stacking. QSBS stacking is, let's say, under the old system, is say, well, gosh, I have so many shares of this startup. I have 20 million. I have 20 million that's going to be redeemed, and I'm going to get $20 million. Well, 20 million will be tax free, but the other 10 million won't be tax free. Do I have to just pay taxes on that? Well, not necessarily. Um, you could gift it to your children in an irrevocable non-grantor trust. Under the QSBS rules, and this is well recognized by the IRS, each uh, QSBS exemption is per taxpayer. So whomever the taxpayer is gets a QSBS deduction, gets basically this QSBS tax treatment. Interestingly enough, husband and wife, the prevailing consensus, even though we're in a community property state, prevailing consensus is you only get one. So even though we're husband and wife, prevailing consensus is only get one. It's a little bit iffy on whether or not you can get two. So what do most people do? People will gift to an irrevocable non-grantor trust. Well, that's gotten a lot easier. Why? Because we now have high estate tax exemptions. We used to have a little bit of a challenge with this when there were lower estate tax exemptions because we say, oh, I can get $10 million tax free, but I have 20 million, I have 30 million. Well, what do I do? Well, I can gift, but I can only gift up to my estate tax exemption, which in the Obama era was around 5 million. Then thereafter it was about 10 million. And then we had 10 million adjusted for inflation, but it was subject to the potential sunset. Well, now we're just going to have 15 million. So husband and wife, we have 30 million. So gifting is much easier if we wanted to gift. One other thing on QSBS that we always have to remember is QSBS is federal law. This is in the IRC, the Internal Revenue Code, the tax code, Title 26. This is not found in the revenue and tax code for California, the R&T code. California does not conform to QSBS. California wants to tax all of those fantastic transactions that we produce many, many of. So California um, does not uh, conform on QSBS. So for that, for not conforming, do be aware that if one has a QSBS, you have a California problem, but then that raises the gifting issue again. Maybe I would gift to a completed gift non-grantor trust in Nevada or Wyoming, something like that, where maybe I'll put the asset over there and I'll say, well, that 10 million will be free of both. Of course, it will depend who my beneficiaries are. If my beneficiaries are minors or they're my children and they'll never leave California, well, then maybe it's not going to work. Then because we have a protective tax called the throwback tax that would capture it. But there are opportunities here. So if one has this, there is an avenue there. Let's take a look at the next slide. There may be a little bit of a typo on this one, but let's see.
Oh, I think we
Oh,
changed it.
oh, okay, yes.
Yes. And also, Michael, if you want to have a water, feel free to do so. If you have
Okay, I have
any
it right here.
question, if our audience, if you have any questions, feel free to type in your questions in our Q&A box. And if we have a little bit time after the presentation, we can answer your questions.
Yes. Similar to going along that line of what we were thinking with QSBS is this idea leveraging the high exemptions, transfers that one may want to start considering. The exemption now is historically very, very high. So doing a gift now, one unless one is at the upper echelons of wealth, many people are not encountering gift tax, estate tax problems under the law presently and where it's going. The consideration on this is, are there moves that may be attractive depending on situation? So classic moves, straight gift moves. My son is going to buy a house. Maybe I just gift him some funds for that, and I just do a gift. Okay, that that can work. Um, Trust-based gifts for transfers for asset protection or multi-generational planning are also much easier because we don't have this limited use of a state gift where you say, well, okay, I'll gift a couple million here, but then I don't have very much state tax exemption left. And then if I pass away, it's going to, the chickens are going to come home to roost. There's going to be a question, that I don't have any estate tax exemption left, and I may have a taxable estate then. Now, with the exemptions being high, we don't have to worry about that. So, classic strategies that perhaps we um, uh, wouldn't consider when the exemptions were low. Upstream gifting. What's upstream gifting? Well, upstream gifting is, let's say I have parents, I have older parents, I want to take care of them, and I want to provide, supplement their retirement and do things for them. Well, I can create an irrevocable grantor trust with my parents as the beneficiary. They would have an unlimited general power of appointment. That would, of course, bring these assets into their estate when they passed away. I know they do not have a very large estate. I maybe have a moderately large estate, but I have a lot of capital gains stock. Well, what I would do is gift some of this stock, maybe a significant amount of this stock, into this special kind of trust. The dividends, etc., I would use to take care of my parents. They technically have the right to power of appoint to aim this at someone else, but they are very glad that I took care of them, so they don't. They just aim it at either back to me or my or their grandchildren. It goes into the next generation. Well, with this upstream gifting trust, when something happens to my parents, when they pass away, it gets a step up in basis. So that is a good way to take care of my parents, to make sure that they are, in good shape and financially taken care of. But it's also a good way to wash potentially some built-in capital gains out of an asset that I have, but I don't have to actually give the stock to them in their hands. I can use the medium of a trust to prevent issues of like, what if my father gets in a car accident, and has an automobile accident? Well, I don't want to give him the asset directly. That would be a mistake. Giving valuable assets to older people is also as dangerous as giving it to very young people because accidents can happen. So, both giving to my children or giving to my parents, I want to use the medium of the trust in case my father drives the car into a coffee shop or something like that, and then, we're going to be sued. Well, it's not going to touch the trust. The trust is a third-party asset protection trust. We're not going to have a problem. This gifting is possible, or I would say at least very much easier, in that, well, if I gift, $1 million of stock via this way, well, okay, I'm going to have to deplete my estate tax exemption, $1 million, but I have $15 million on it. So I'm now at 14, just for inflation. If I can avoid capital gains on a lot of that stock that was built into that stock that I have, and it will take care of my parents for their lifetime. Great, great. I'm happy. It works well, and it's not as problematic as a transaction when we used to look at this, really, under the lower exemption scheme, and we say, it's the income tax part is nice, and the care for parents part is nice. That all looks good, but do you really want to use your estate, you know, gift exemption on that? I don't know if it's a good idea. Well, now we don't really have that concern. The same way gifting to non-grantor trusts for children if the children are going to live out of state. So if I have children and they're college, post college, and they are they're going to go live in Texas or Florida, or Washington State or something like that. I say, maybe I'll gift them a significant amount of money. Well, I could gift it to them directly, or I could gift it to an irrevocable non-grantor trust in Nevada or Wyoming, something like that. Um, and then I don't have a California nexus anymore because the asset is now in Nevada, or in Wyoming or wherever, not New York or not New Jersey, or not California, where we have very, very high income taxes. It's in a non-tax state, and the beneficiary is in a non-tax state. Well, I can grow that asset subject only to the federal tax. It's now in a non-tax state. And depending on how I appropriately set it up, it can grow, and we don't have to worry about the California state tax. It can grow for the beneficiary in this tax preferred vehicle, but I don't have to just give it to my son in Florida, because giving $1 million to my son who's now going to college in Florida is probably a bad idea. Florida is very warm and sunny, and people, get into trouble. So, my 20-year-old son, at University of Florida, probably shouldn't give him the $1 million. Maybe I can do the trust, settle the trust for him. I can start taking advantage of, well, that's going to grow for years and years while he's in Florida without paying the California tax. And of course, it will dole out the income and all of that to him just like that. So these types of planning with trust, sophisticated trust planning beyond just the, I'm giving away my estate. Maybe there's an income tax play here, for step up in basis, or for directing income to a non-California person and situsing the trust in a non-California area. That all is now easier to do. So that is available and works quite well when we have high exemptions. So let's keep on going and go on to our next thing. Ah, so this is going back to what I was mentioning before about the charitable planning about trusts. So with the charitable planning, is really thinking about, like, number one, the first thing that we talked about is thinking about the timing of the gift. We've only got 14 days left of the year, so we're a little bit tight. We're a little bit tight, to do much this year. In a real crisis, probably could do some things, but we're a little bit tight. But one of the things that one should be thinking of is if I was going to do some bunched gifting. I'm going to do a lot of gifting all at once. I'm going to do it now. I do have to watch out a little bit for the 0.5 percent floor that's coming next year. So that is an issue. The other thing that I would want to start taking a look at, and this is not necessarily an end of the year issue, but it is something that we recommend people taking a look at really all the time, perennially throughout the year, is your medium of gifting. Yes, I can drop things off at the Goodwill. Yes, I can do a check to the school. Yes, I can do a check to the college, all of those things. And those things are all great. Those things are all fine. They're very good. And on the general scale, they're good. If I am a taxpayer that I start to realize that I am a very high income taxpayer, or I'm a very high net worth taxpayer. Maybe I have some people that have very, very high income and very high assets, some high income, low assets, some high assets, low income. This happens a lot. Sometimes, depending on people with certain kinds of real estate, sometimes have that issue. Um, I want to think about my medium of gifting. And medium of gifting is, do I look appropriate for a donor advised fund or a private family foundation? And really what this is, what these uh, vehicles are, donor advised fund is generally set up by your brokerage, and this enables bunched gifting. I can just say, oh, I this was a good year. There's a lot of income and dividends this year and ordinary income. Taxes are going to look so not so good, come around, March, April when I start to calculate it. You know what I want to, and that floor thing, I don't really like that floor thing. I want to just give, a big gift. I'm just going to give a fairly large gift because, the cash is sitting there. Why not? I'll get a little deduction, and I want to help. I want to help. And then you kind of say, help what? I say, I don't really know. I want the deduction and I want to help, but that second part, I don't really know what I want to do. Well, the donor advised fund or the foundation are very good for this because you can throw in the $10,000, the $50,000, the $100,000, and you don't have to give it to the third party public charity in 2025. You can dole it out over time. And that can be very helpful, especially if you are high income or high wealth, uh, I, either one of those taxpayers, so that you have a place to say, you know what, it's been a good year. I just want to shove this into the uh, charitable vehicle, take the deduction now, and I'll figure out what to do with it from there. The donor advised fund is one of my favorites. Why? Because you don't really have to do anything with it. The brokerage does all the tax returns. The brokerage limits what you can invest in so you don't invest in the wrong thing. It limits basically what you can do with the account, and it limits the beneficiaries, the charities that you can give from it. So it is, sort of charitable planning for dummies. Those books that were popular in the 1990s that I liked very, very much. It was like that. You really can't go wrong with the donor advised fund. The problem with the donor advised fund, which can be an issue, is the donor advised fund can be too limiting. People can say, well, actually, can you work for the donor advised fund? No, no, the donor advised fund is a fund. It's not controlled individually by you. It's controlled by the brokerage and, by the custodial agreement that you have with them. It's like, okay, so you can't do that. Can I start doing like public works? Can I start to like get involved and start to do my own programming and do all these things? No, no, you're not a public charity. That's not what the donor advised fund is for. It's for you throw all the money in there, the $50,000, and then next year I say 5,000 to this and 5,000 to that, and I wait and I do next year 5,000 to something else and 10,000 to something else is for that. So it's great if that's all you're trying to do. If you are trying to do significant, long-term coordinated family gifting, one probably wants to look at the private family foundation. The private family foundation is flexible, uh, versatile, uh, operates just like the donor advised fund, has a lot of ability to do really powerful, impactful, charitable giving and charitable services. But like the metaphor I often use regarding irrevocable trusts, and boy, it's really apt for the metaphor for private family foundations. Getting a private family foundation is like getting a husky dog, like a big, like sled dog, and saying, "Yeah, I'm going to have the big sled dog. It's beautiful. It has blue eyes. I love this dog. I'm going to get this dog." Okay, great. It is a beautiful dog. It's a lot of fun. And then all of a sudden you have the dog for 24 hours. And they say, "Oh my God, this dog is so much work. This dog has so much energy. It acts as if it wants to pull a sled in the snow all night." It's like, yes, that's what they're for. That's what he was bred to do. He's full of energy. He's bred to do this. He's going to do this. If it is if you don't watch him, he's going to get into trouble. It has a lot of energy and it can kind of go wild. Well, that's the private family foundation. Is the private family foundation is so manual. You're the CEO. Part of your family is going to be the CFO, the secretary. You're the board of directors. You have to do all of this manually. You have to keep all of the records. You have to file the 990 PF. You have to do the annual 5% dole out to the charities. By the way, actually, one of the things, end of the year, next 14 days, make sure if you have a private family foundation, you doled out the 5% minimum distribution to the charities, less expenses that you're supposed to. You'll get into big, big trouble if that gets caught and you weren't doing that. So be sure to do that. I had clients that I always get down to the end of the year and they freak out about that because they realize they didn't order checks from the brokerage account. That they opened a brokerage account and they're like, how do I get the payment out? And I need to write a check and I didn't order checks. And you have to overnight checks to yourself so you can write out a check for the 5% to make sure that you get it out the door. The private family foundation is super versatile in that eventually, if it's well funded, people can work for it and they can take a reasonable salary and receive reasonable compensation. It can be designed very, very well and really do impactful public service. But you do have to be careful with it because just like the husky dog, if you say, "Oh, I'm going to go away for the weekend. I'm going to Napa Friday, Saturday night. I'll just leave the husky in the house with, 2 bowls of food and water. Everything's going to be fine, right?" Well, when you come back on Sunday and the house is totally destroyed, you realize, "Oh, I can't I can't leave the husky. I have to watch it constantly." Yeah, the private family foundation, you kind of have to watch it. Constantly no. What do you do like with the husky? What do people do when they get it? Well, you hire a dog walker and you hire somebody to watch it. That's what we do. We do uh, as professionals, as lawyers, and then also accountants can assist. For thinking about private family foundations, we really have to be thinking in at least it doesn't necessarily have to be initially, but we need to be thinking about like six figure. It's going to be holding six figures, I think. Most of my clients tend to be larger than that, but not all at once. Is generally, some of them start small. I mean, some of them, have $10,000, $50,000, but there's definitely an understanding that, well, that's just year 2025. This thing's going to be getting, year over year, 50,000, $100,000 donations. It's going to be pretty large. Because if, we're operating a private family foundation and it only has $10,000 in it, the administrative expense to run it is going to be 20 to 25% of its core assets. That's not particularly effective. So that's uh, uh, a guidepost for private family foundations is scale is important. Again, if I'm just going to, $10,000, I'm just going to do it here and there, and I'm not going to do it every year, maybe donor advised fund is just easier. Because again, how are you ever going to have someone, children, et cetera, say, "Oh, I work for my private family foundation." I say, "How much do you have in it?" And say, $26,000. But I mean, you're not really going to be able to draw, very much compensation from that because it doesn't really take much work to administer $26,000. So scale is important. So
Michael, I have a
yeah,
follow-up question. So, a lot of our clients, their kids, they are attending private schools. So, at this time, usually we always get this question from our clients, for donation to private schools. What kind of a charitable vehicle do you recommend to use?
is this one, it depends a little bit on the school. The Private Family Foundation works quite well. One of the things with the Private Family Foundation that can work quite well is a timing issue with schools, which is somewhat interesting. And this goes for the grade schools and even university, is many schools operate on a fiscal year that looks almost like the academic year. And so what does this mean? And where it can be an opportunity for the taxpayer is oftentimes if I'm using the private family foundation, I can make the donation in 2025. I can make a large donation to my foundation, but I won't give the money to the school until the spring during their fiscal, which is still within their fiscal year. So I can do the donation to the school actually in 2026, and they will receive it, but because of their fiscal year, it actually is on their 2025 year. So the Family Foundation works well and is much more flexible. Donor Advised Fund may not necessarily always work with the school because some donor advised funds have sort of a limited list of the eligible public charities. So one just has to be a little bit careful with the donor advised fund just to make sure that it is flexible enough that one can do what one's trying to do.
Great.
Right.
I think you already answered this question. What size of
Yeah.
assets, yeah, should consider? I think this is just, it really depends on the situation. But as what you mentioned, it needs to be worth it to set up the structure because you do need to spend some money to keep it running.
It's the operating cost, really, is that there's setup costs, and this does have a heavier operating cost than um, other vehicles. Also, the private family foundations or and any charitable vehicle, and this is not I wouldn't be as like donor advised funds don't have this problem because it's all done for you. And then even things like a charitable remainder trust really doesn't have such a problem because the charitable remainder trust is very rigid. So there's not really problems with that. But private family foundations and any sort of general charitable vehicle, one does have to be careful because they do get a fair amount of IRS and FTP scrutiny because there are very, very strict rules on private inurement. So what was private inurement? You're getting a tax deduction from this. You can't benefit from this, uh, off book. So what do we mean is I can't borrow money from the foundation. I can't uh, rent property to. So the foundation cannot rent space in my office building. Even if I have an office, they say, well, it's paying below market rent. Do you own it? Well, it's renting from a disqualified person, so you can't do that. There's a number of transactions that it really cannot do, so you have to be careful. So what does this mean? It generally has more lawyer involvement for saying, "Can I do this?" And then a lot of times it'd be me basically saying, "No, you generally can't do that because that looks like private inurement, and you have to be careful." So. These ones require some oversight. Great. Let's move on. Actually, we have a few more things to talk about, so I want to go maybe a little bit faster so that I can get everything in. Oh, this one actually is a place where I could go a little bit faster. Um, End of the year. This one perhaps we could even save because a lot of people do it by tax time. You always want to double check your estate plan and make sure your estate plan is matching what you want. What life changes happened in 25, what wealth changes happened, new entities, new real estate, relocation of your fiduciaries or beneficiaries, it's always good to take a look and say, is my estate plan still grounded in reality? Or is there something where my estate plan just doesn't really look the way my family looks now? So then you'd have to change that. I usually recommend this because most people don't like to look at this thing during the holidays. Myself, I tend to not look at this thing during the holidays. I usually tend to look at it in the spring when you start getting all the 1099s and all of those things because it's a good way to queue up of like, wait, 1099 from wherever, Schwab, 1099 from Morgan Stanley. Oh, we didn't mention Morgan Stanley in the trust. Oh, well, now you better go do that. So
But
that type of thing.
sometimes I also have clients they like to mention this to their family members during this time because it's a classic family gathering time. People are in good mood. So I guess it
That
really depends on
I
different
do.
family.
That is true. This topic does tend to come up a lot. That people start talking about planning, involvement, things like that. So it is always good for that. And it's always great to mention that you know a good lawyer. It's always good to spread that around at a holiday party. Maybe you know one. I don't know. So a little bit of fun there. So good. That's always good to keep in mind. Let's move on our next one. Yep. Oh, it's just our 14-day action plan. Boy, we're tight. Can you believe 14 days till the end of the year? Really just taking a look at everything. So if your inventory, your model, make sure everything is queued up and signed and where it's supposed to be. And then thinking about sort of a checklist of end of the year things. And really what I like to take a look at is our kind of top 10. We have a kind of a list of things to think about. So here are some top 10 things that I recommend taking a look at. So, number one, your 2025 tax projection, if able, run a little bit of a quick projection on this. Why? For charitable planning. I have so many clients. It always comes up usually in around March or April as they realize like, wow, the number's so big. What can I do? Nothing. 2025 year ended. You can potentially do a um, you know trad IRA, traditional IRA, if you're the employer, that's not, that will count backwards in the year, but that's only $7,000. There's not very much you can do. But if we know now, we still got 14 days we can do something. Same thing, loss harvesting and managing gains. This is also something that if one self-manages your brokerage, if you look at your portfolio, of course, maybe don't looking today, it was pretty ugly out there on the market today. Today was kind of an ugly day. But this can be it, is that if you had some good winners and you say, I sold some winners earlier this year. Well, if you say, some of these are losers, I got to dump these. Well, it's better to dump them now to harvest the losses in this year to offset the gains because the long-term loss can offset the long-term gain. You have problems if you have the long-term losses. You can't bring that to ordinary income over $3,000. So if you have these built-in losses, you really can't move more than $3,000 to ordinary income. This is the same way is if you say, well, I have losses. I sold something, because I had to get out of it, and I have $10,000 worth of losses. Well, maybe you want to sell a little bit of a winner because you can offset you can cash out a little bit of a winning stock and use some of that loss because otherwise you're going to have that $3,000 limit and then that loss is not going to be used and that could be valuable. So optimizing tax loss harvesting or reaping some gains to use the loss, that can be valuable. Take a look at that. We have 14 days. Of course we only have trading days, but we've still got some time to do that, and it's easy to do. Optimized giving, if you're thinking about doing a deductible gift, well, you got 14 more days. And then also always think about the mechanics. Like my private family foundation, do you actually have the checkbook? Oh, we don't have the checkbook for the brokerage account. You need to get the charitable donation completed. You have to write out the check and sign it and deliver it. Doesn't necessarily have to be cash, but it does have to be, signed, sealed, and delivered as the legal doublets used to be, signed, sealed, and all of that. You need to do that. If you did a non-cash gift or you're planning to do a non-cash gift, this is a little bit tight, but start thinking about um, the documentation of like, did we, do the appraisals, the 82, 83, did I think that through or, remember, in the early part of next year, I got to go get that appraised, that thing that I gifted, because those will require substantiation either for the gift or for sometimes for the charitable deduction. And then don't forget your annual exclusion gifting. This is for estate gift taxes, $19,000 per year. So if you want to do the tax-free gifting, the estate gift tax gifting, well, we got 14 more days to write out those checks. The same way for if you have like an ILET, if you haven't funded the ILET particularly this year and you wanted to get those your crummy beneficiaries, your crummy withdrawal, all of those, use that 19,000, get that sent over. So don't forget again, because if once it passes midnight, once it's New Year's, then that 19,000, that was a 2025 thing. Now we're in 2026. Well, you do it in 2026, you use the 2026 one, but you lost the 2025 one. So make sure you do that. Let's see our next five. Oh, large gifts. Yeah. If you want to do large gifts, still 14 days for that. That's always good. Beneficiary designations never hurts to be aware of your beneficiary designations. Update fiduciaries and all those terms. Never hurts to do that. QSBS, always good to be in line for that. And then, I think closing the loop, implementing or calendaring follow-ups, it's also a good time. There's only so much we can do in 14 days. Even my office, as I empathize with all of you. We do get inundated with emails and appointments, in these last few weeks. So bear with us as we reply to everybody. But a lot of what we're doing now is calendaring for January, is because it's not practical or reasonable to complete now, and unless it's absolutely a crisis, which I mean we've had one where the person had a buyout and then they didn't do any really charitable planning and they really needed to do it very, very quickly. Sometimes we have to, one has to do it. But those would be the things to think about. Think about maybe, how do we make January and February a little bit easier, because we'll set some things in queue now, or at least we calendared it. So that's what we have now. I think the key things to just think about is that your $19,000 gift, make sure you do that. Any charitable things you want to do that. If you have a private family foundation, remember that 5% has to go out the door. Anything that's tax timed that has to be within the year 2025, well, we have 14 days left. So in our final 2 weeks, that's what we want to do. And that's the final stretch before we have a Happy New Year and Merry Christmas. So that's what I have for everybody tonight. I hope that was enjoyable, and we can go from there.
Thank you so much, Michael. And we still have about 8 minutes, and we have two questions, two very quick questions. Maybe we can go over the questions and conclude this year's webinars. So the first one is this person asked if we do special needs trust. The answer is we do. We do both. There are two kinds of special needs trust: the first party special needs trust and the third party special needs trust. Usually the third party special needs trust is more common. Is parents usually want to take care of their special needs children. We do that, but sometimes if the special needs person receives a large fund, for example, got a settlement from accident, for example, for that kind of case, we usually set up, it's called a first party special needs trust. We also do that. So feel free to reach out to us via email, WeChat, or call us, text us. We're happy to help. The second question, this one is this is regarding trusteeship and trust management. My daughter and I are the trustees of my revocable living trust, and I put my house into the trust. Can my daughter sell my home by herself alone, since she's the co-trustee of my trust that owns my home? The answer is it depends on how your attorney designs the trustee appointment, the trusteeship. So sometimes when we design the co-trusteeship, we do, the trustee can either act jointly or act alone. But sometimes if the trust requires the trustees to act together, then it may require both you and your daughter to sign to sign the paperwork.
The legal default under the probate code is when you have multiple trustees, it must be always unanimous. But be careful, usually it's the latter part of the trust towards the definition sections, or in the trustee part, that it sometimes may have a provision that says either trustee may act for routine acts of administration. Generally, selling property wouldn't be a routine act, but it would be something if one is concerned about it. I would recommend reviewing the trust and making sure that it requires unanimity of both persons. You don't have anything where routine acts can be done by one trustee, and make sure the trust certification says that, because a title company is going to look at the trust certification. You want to confirm that.
But the second question, I think is relevant to what you just said, Michael. The second question is, how can I prevent my daughter, the co-trustee, from selling my home in the trust? But sometimes in reality, if you name your daughter as a co-trustee, and you make sure the document, everything is okay as what Michael just suggested. Legally, I think it's okay. You can prevent it, but still you need to be really, really careful, because before we even see, sometimes people would forge the documents, forge the signature. So, it just, you need to be really careful when you name someone as the co-trustee.
Yeah. If one has starts to get very significant concerns as to having a co-trustee, and I was the settlor, it may be an indication that I need to amend and restate my trust where that person's not the co-trustee. Because having this fear may be indicative of a problem. Maybe it should be that I'm the sole trustee, and then my son or daughter will become the trustee after I pass away, or some other combination.
Mhm. And the third question would be how to prevent the disinheritance of children from a prior marriage when a surviving spouse remarries. I think this one is about the Q-tip. You can design a Q-tip style trust to restrict the right of the surviving spouse in somewhat way. Is that, if that's what you mean, if I
This one I'm not sure, because
correctly?
if I read it just straight, if it's how to prevent disinheritance of children from a prior marriage when a surviving spouse remarries, if I have children of my first marriage and I divorce and I remarry, and I wish to, of my new estate, I wish to disinherit them, there's nothing that can stop me from that. Um, I have complete testamentary freedom. If it's a situation that I'm married now and I want to protect my current children
I
in case
think
I pass, that can be done with a Q-tip trust.
I think this question, maybe she's married before and she has a child, and she's worried her current spouse disinherited her child from the prior marriage after she passed away first.
Oh,
Uh,
yes, yes.
I
The
think it
two tip
depends
would do
on,
that. Yeah,
yes,
yeah. This one we would need more. We need to get into that one, how that
yes,
works.
I think it depends on, what kind of assets. If it's your separate asset from prior marriage, you can set up a separate trust to protect your uh, children from prior marriage. But if it's community property, you want to make sure your surviving spouse would, after you pass, if you pass away first, you want your surviving spouse to provide for your children, then maybe you need to consider the restrictions to the surviving spouse. Okay. The next question is, can we give real estate with startup basis, no gain into IDGT to get assets out of the estate?
So the answer to this in the initial answer would be yes. If I have real estate and I say it does not have, the basis, maybe I had just inherited it. So I just inherited the real estate. It has a step up in basis, so it's basically fair market value. So I don't have any gain. Could I then simply gift it into an IDGT to get it out of my estate? Yes, I could do that. But one of the things that I have to think about is first, if that real estate is in California, depending on who the beneficiaries are of that trust and what the status of that property was, it is very, very likely that by gifting that real estate into the IDGT, I will cause a property tax reassessment.
Mhm.
So if I gift real estate into the IDGT, that will probably cause a tax reassessment of the real estate. And so that real estate gift may not be such an ideal uh, asset to put into an IDGT. And the reason why real estate is sometimes problematic for the IDGTs is the property tax reassessment rules. So if it was like my example, they said, well, I inherited this property and it was from my uncle. And so I inherited it and I got the step up in basis. And I also, because it's uncle to nephew transaction, um, it was reassessed. So it's already reassessed. Well, then maybe it would make sense. Uh, I'm not creating a capital gains tax problem by gifting it in because that already got reassessed or that already got stepped up, and I'm not causing a tax reassessment. But if it was a situation that we were husband and wife and we had a couple of rental properties and my wife passed away, and so I got the step up in basis on on all of my rental property. I would have gotten the step up in basis on all of my rental property, but I would not have had a property tax reassessment. But if I then move that real estate into an IDGT, that's a change of ownership, and that will cause a property tax reassessment. It will cause the property tax potentially to go up if there's a big difference between the my current adjusted tax basis and the fair market value. So I would say IDGTs in real estate, one has to be quite careful. If one has questions about IDGTs in real estate, definitely get in touch to talk to us because there's a lot of moving parts with that one because there is an additional tax system, which is the property tax system. And as we
Mhm.
all know, with our property taxes in California, it's not small. It's not a little number. That can be very significant amounts if it gets stepped up. Or I shouldn't say the usual word stepped up, if it gets reassessed. So that one we really have to be quite careful with.
Mhm. And our office speak Mandarin Chinese and Cantonese. So, if you need a language assistance, we can help as well. This is to answer this question. Do we speak Chinese? Last question. How do I know whether a GRAT or IDGT suit my need? I think the answer is those are very complicated legal structures, and you need to discuss with your attorney.
I could throw out some shorthand.
Sure. Yeah, go ahead.
A GRAT is generally for a design where I have a property that I believe is going to increase faster, that the value is going to increase faster than over the period of time than basically me uh, you know uh, basically the increase for the estate tax limits. There, I should say, basically that the asset is going to increase in value faster than the IRS AFR rate, the applicable federal rate, which is like 4%. So basically what it is, like the GRAT, is I say, well, I have $1 million of stock and it's going to grow at 8%, or I think it's going to grow even faster than that. So a GRAT, generally, I throw the $1 million worth of stock in there, and the GRAT will be, generally GRATs are short term. And what it would do is each year, the retained annuity, it will pay me back 330,000, 330,000, 330,000, over the 3 years. And what has to happen is that as that $1 million I put into the GRAT, as that increases significantly in value, basically the GRAT shaves off the top. The GRAT shaves off the top. So GRATs are generally used to put assets that are going to have high appreciation. You use the GRAT for assets that will have high appreciation in value in order to get the asset, the appreciation out of the estate and keep the value frozen at, let's say, $1 million. The GRATs work very, very well for that. The GRATs are not for straight gifting. If I say, well, the estate tax is up to $15 million, I'm just going to throw the $1 million in. A GRAT won't work. A GRAT tries to pay it back to you. It's gonna, you sort of you throw the thing out of the, out of the boat, and then the fish jumps back in again, and you throw it out of the boat, and then it jumps back in again. That's the way the GRAT works. The IDG, the IGDT,
IDG.
IDGT, intentionally defective grantor trust, can be can be a box, and I just throw the $1 million in and I say that's the end of that, and it's not going to come back to me. Um, the GRAT with a sale to a GRAT looks, I'm sorry, a sale to an IDGT, a sale to an intentionally defective grantor trust mimics the GRAT. But I would say with these high exemptions, I have not seen and personally done as much GRAT planning as we used to do when there were low exemptions. Why did you do a lot of GRAT planning when there's low exemptions? Because you can have what's called a zeroed out GRAT. I can basically create the GRAT where it's just shaving off the top, and not touching any estate or gift tax exemption. And that's what people liked about it, is that I wouldn't be touching my estate or gift tax exemptions. And the asset was always coming back to me. And it can be very good if I don't really also, if I say, well, I don't really want to give my son, the $1 million, I just want to give him the growth. Well, okay, then the GRAT's maybe the right choice. But if I really say, well, I just want to get rid of the $1 million and the growth and everything and all that, it's just going to go into the box and I'm going to be done with it. IDGT is better. So just think about the GRAT has that grantor retained annuity. It's going to try to flow back to me. The IDGT doesn't necessarily flow back to me. In its standard form, it doesn't flow anything back to me. I put it in, and it's the charity box, or it's the box at the farmer's market, that it's the locked box with the little slot in there. You put the money in, but you can't get it out. The IDGT works that way. If you do a sale to the IDGT, you can make it look like the GRAT. Really, if as for any clients, if one's deeply curious about it, of course, feel free to contact us, and we may even have a YouTube on the GRAT, because we went into the IDGTs a lot. The GRAT has a lot of limitations, and sale to an IDGT is generally considered more flexible.
Great, great. Okay, thank you so much. Thank you everyone for joining us tonight, and we wish you a Merry Christmas and a Happy New Year. And we'll see everyone after after 2025 next year. Have a
Take
good
care,
night.
all. Good night.